It is now ticking up on Bloomberg data up to a 90%. That means munis look relatively cheap. Is now your entry point to buying into this market?
Definitely, Taylor. I think it's a really good time. As you recall, when I was on back in August, I was definitely pretty reserved on the muni market. That ratio had gotten really rich. If you recall, treasuries plunged down to really low levels in early September, and muni yields got down there with them. And I think there was some real sticker shock in the muni market. Then treasuries backed off, and munis sold off with treasuries and then some. And I think the big reason was the sticker shock and more supply coming into the market. And as you said, right now, at that higher ratio of munis to treasuries, if you buy a AA rated muni in 10 years, you're picking up almost 100 basis points over treasuries on a tax adjusted basis. We think this is a pretty good entry point into the market.
Well, I want to talk about another portion of the market, which is the taxable portion. Now, I was taking a look at 30-day visible supply in the taxable side of this market, about the third highest it's been so far this year. Why the increase in supply on the taxable side?
It's a really interesting question. So that low rate environment that I mentioned before has created a ton of refinancing activity in the taxable muni market. So you can no longer refund a higher yielding tax exempt muni deal in the tax exempt market. They did away with that in the Tax Reform Act. But you can do it in the taxable muni market if yields get low enough and the numbers and the math add up. And that's where we are right now. So there's a lot of demand for taxable munis from overseas investors. It's been a real growing part of our business. And this new supply that's come in from those refundings in August and September has been a really, really good thing for the market.
There's been some talks about some cracks in the corporate junk side of the market. Do you see cracks in the muni junk market?
Not yet, but it's definitely time for caution. I still like the high yield muni market. Right now, the broad market yields about 3%. That's a taxable equivalent of over 5%. There's not much out there in fixed income for U.S. tax-paying investors that looks like that. But to your point, Taylor, you have to be cautious right now because we're moving to the end of the cycle. And I will tell you, over the last 2 or 3 years, just about any deal that could get done has gotten done in the high yield muni market. The rubber's going to hit the road for some of those bonds. They're not all bad, but I think you really want to know what's in your portfolio. And one other piece of advice I would give investors right now is if you have a bond in your portfolio that you don't like, it's probably a good time to sell it. Don't wait till volatility picks up.